Hi, everyone. Good morning or good afternoon. Thank you for joining us today for this European American Chamber of Commerce webinar. We have folks coming into us from all around the United States and the world, actually. We really appreciate you spending an hour with us today to go over this very important topic. My name is Brian Dolan. I'm a marketing director for the law firm Pepper Hamilton, one of the sponsors of the European American Chamber of Commerce. Before I turn it over to the speakers today, I had a couple of quick housekeeping items for folks. If you haven't joined one of the Pepper webinars before, since we're driving this today, you're hearing us through your computer speakers. Ideally, if you don't like how that sounds or you can't hear me clearly right now, you can always ask for a phone number. If you click the phone icon highlighted here, you'll get a phone number right away, and you can hear us on the phone, but watch the screen for the slide deck, and also on the screen, you can hit the Q&A button to ask us any questions at any point that you would like. With that, I'm going to turn it over to Yvonne, who's the Executive Director of the ACC New York. Yvonne, all over to you.
We have a very high we were just looking at the RSVPs. We have very high attendance this morning, not surprisingly, considering the topic. We felt that after our conversations that we had about the stimulus packages themselves, this is a good time to talk about some of the after effects. And we were lucky to have 4 experts in the EACC network who could help us, explain what you need to know now and give you practical advice on how to deal with the stimulus packages, what you need to know about the record keeping and best practices around this and changes that have been happening since. So I will hand over to Amy Moore. She's with Clifton Arson Allen, who is going to be moderating the program today. And I would like to thank all of our speakers for making themselves available for this discussion. And with that, Amy, the floor is yours.
Wonderful. Thank you so much, Yvonne. And thank you all for finding the time to join us this morning. The goal today is to have our great group of speakers to kind of give you some real-time thoughts and feedback on all the moving parts of the stimulus packages. We've got Chris Rossi from Pepper Hamilton, who's going to speak to us about the forgiveness piece of the PPP. William Avedon from Tradewind Intelligent Trade Finance, who's going to talk to us about some other avenues for capital. And Lori Keel from Osborne Clarke, who's going to give us some information about the differences of what we're seeing in Europe and the United States. Brian, do you want to go ahead? There we go. So our agenda today is just really to provide a general update of the status in the United States of the moving pieces here. To talk a little bit about the key differences between the U.S. and the EU related to COVID-19. Most of you are foreign businesses, so you're dealing with it in different countries and the nuances there. Discuss an update of the Paycheck Protection Program, as well as the forgiveness. Providing you some reassessing some other programs if you did not decide to take the PPP. Looking at trade finance and other collateral based on short-term and medium-term lending and options. And then looking at some of the U.S. tax opportunities that are in front of you currently that came out with the CARES Act. A lot of people are reassessing now that they've gotten through the initial steps of the PPP. Generally in the United States, we have various different acts that have been passed by the government to support COVID. And as many of you know, looking at the attendance list, you are in the United States, but we do have a few international, and I get this question on a regular basis. Are you open for business, and what does it look like? And really, when you think about the United States and you look at this map, you can see it's a pretty large area. So when you think about that from a general standpoint, it depends on the city and state you're in. It depends on what you mean by open for business, but generally the U.S. is moving towards opening offices and opening up commerce. It is being done in different phases throughout, and so that varies based on what city or state you're in, and we'll talk a little bit about that as we carry forward into the conversation of comparison to the EU. So again, the federal legislation that was passed, and I'm not going to go in a great amount of detail here since most of you probably have been aware of this, but there has been the first bill that was passed, the initial support for vaccine development, and that really related to getting prepared and getting the country prepared for supporting COVID. The second bill, which is the Family First Coronavirus Response Act, was really directed towards providing worker assistance, knowing that unemployment was coming and increasing the amount of unemployment that was there. It was also for companies that had less than 500 people, providing sick time if people were impacted by COVID. The third bill is the one where we're going to spend the most of our time on, is the CARES Act, and that's where the major stimulus package came in for $2 trillion, and it was broken down between scale of business, and that's really where the PPP comes in, versus the larger entities. There also was some direct payments to individuals. After that bill was passed, there was a second funding that was added to increase the paycheck protection as well as the EIDL, as well as an increase to hospitals and healthcare providers, as well as providing funding for COVID-19 tests. Also within there is the Main Street Lending Program, which is for companies with have more than 500 employees to 10,000 employees. And we will provide a little bit of an overview of what that looks like and where it stands currently. So now, before we jump into the specifics of the PPP program, I wanted to introduce Lori, who's going to just talk a little bit about how it looks in the EU and specifically the UK, how they are handling COVID and what the current situation is, to put some context around it for our US companies that are either foreign-owned or for our companies that have subsidiaries in other countries. Lori, I hand the floor over to you.
Thanks very much, Amy. I appreciate that, and really good to be speaking to all of you today. Just by way of background, I'm a partner in our London office. I specialise in finance and banking, but we do have offices all around Europe, so hopefully I'll be able to give a little bit of a taste in terms of what's going on around Europe and the main jurisdictions that we operate in. I think it's a really interesting time actually to be talking on this. Many of you will have read in the Financial Times this morning actually that for the first time in what seems like a long time, both consumer and industry confidence is reported to be up around Europe. And that's a general trend, but it belies, I guess, a difference between certain economies. So in particular, the Netherlands, Germany, Spain, confidence really is up. And we're seeing that as a reflection of the fact that lockdown has been very much relaxed in those jurisdictions. And although there is still social distancing in place, you're seeing in particular in Germany that those measures are allowing people to get back to work. However, in jurisdictions, in particular the UK and France to a certain extent, lockdown is still in place and confidence is less strong. I think we can generalise the measures that are being put in place in the EU under two broad titles. Firstly, kind of people measures, if you like, and then general financial assistance measures. And of course, when we talk about Europe, we're talking about around 30 different states, if you include all of the EU states plus the other principal states that are outside of the EU. Now, certainly for those EU states, whatever measures they put in place are, of course, under the general umbrella of what the EU requires them to do in terms of maintaining certain regulations. So both in terms of those people measures and the general financial assistance measures, EU state aid rules apply. And in general terms, the EU has stated that wage help during the coronavirus crisis can't exceed 80% of gross salary and can't go on for more than 12 months. That's the current state of play. In terms of general financial assistance, I think we're all aware of the EU state aid rules and the fact that they have governed business in the EU for a long time. But also, it's times like this, and if you think back to the 2008 financial crisis, it's when those state aid rules are really tested to the limit. And many of you will have seen the fact that Ryanair, which is one of our principal short-haul operators in the EU, has challenged the fact that Lufthansa, the principal German airline, has been granted what it sees as illegal state aid. So I think that's a good example of how these times really do push those regulations to the limit. But in terms of, if we go back to those broad two categories, in terms of people measures, if I focus on the UK in particular, because I think it is typical of what most states have put in place, although some states such as the Netherlands have more generous measures. The UK is probably typical. So in the UK, for example, employees' wages are supported to 80% by the government, up to a maximum of £2,500 gross per month. And those measures are in place now at least until August, and it's an open question as to whether they'll go on longer than that. I think a key question for many of your businesses is the sectors that they're in and how quickly you feel that sector will rebound. Because actually what a lot of businesses are telling us is that actually unless social distancing measures and the like are loosened significantly, then actually with the furlough measures in place, it will be cheaper for those businesses to stay shut and not operate than it would be to operate at, say, 50% capacity. And if you think of airlines in particular, but also the hospitality industry, bars and restaurants and what have you, you can see that is clearly going to be the case. So those are measures that those furlough measures and how long they last will be key to the extent to which you can operate in the short to medium term, I think, in most European jurisdictions. I think the general financial assistance measures, if we turn to those quickly, again, if we take the UK as an example, because most states have put in place similar measures, Germany has a very comprehensive quick loan program, but the UK has tried to replicate that, both for small businesses, startup businesses, but also for medium and even large businesses. So we have a commercial paper support program, which is for the very largest, mainly listed businesses. We have what we call the Coronavirus Business Interruption Loan Scheme, and then the Coronavirus Large Business Interruption Scheme, all the way down to the Future Fund Scheme and the Bounce Back Scheme, which are very much for early start, early stage or small businesses. Most of the businesses we deal with access the Coronavirus Business Interruption Scheme. And what's interesting is that recently, over the course of the last 2 weeks, the government has been explicit that access to those schemes, that there will be a quid pro quo for that in terms of the way in which you can take out dividends or increase executive pay over the coming years. So a lot of our clients are looking very closely at the extent to which they actually need to access those formal schemes versus the more informal ways in which they can access liquidity in the short term. So drawing down on their revolving credit facilities, deferring payments of PAYE, value-added tax, and corporation tax. A lot of those more informal measures are the measures that our businesses, our clients are tending to take in the short term. Amy, shall I come back over to you?
Yeah, I think that there's a couple of broad themes I just want to highlight. I spend a lot of time helping multinational companies, and it has been very difficult for companies with multiple subsidiaries, which maybe they don't have scale in other countries. There is a link on the U.S. Chamber of Commerce that's also on the European Chamber's website that gives you a really good overview of not only the programs that Lori was kind enough to cover, but also some tax incentives and some other pieces. So, our goal here was to give you a broad brush of consumer confidence, what was happening. If you have not had the opportunity to look in the countries that you're operating, it is a great resource to start. And Lori and Osborne Clarke in the UK and their network of attorneys can help you look at all the other countries. So if you have not done it, what I do find is there is assistance for companies that have smaller subsidiaries, and it would be a good connection for that to be there. Thank you so much, Lori. That was really helpful. The only other thing that I found interesting, is that in the United States, it's unclear as to how long at this point, it's unclear on how long the additional federal unemployment is going to be there. And so coming back sooner is definitely, I think, aiding to opening the country a little bit more versus in most of Europe, it does seem to look to be out longer, providing that concern for businesses. So thank you for highlighting that.
No, absolutely, Amy. And that's a really interesting point because we have surveys here in the UK that suggest that the majority of people feel either better off or just as well off as they did prior to coronavirus, which is a slightly perverse outcome, if you like, and is obviously not conducive to business getting back to where it was.
That's right. Well, thank you so much.
Not at all. Thank you.
Great. We're going to move over now to provide a high-level overview of the stimulus packages in the United States and then really focus on a few of them that we believe you guys have some interest in. So again, to highlight what those pieces were, is there are some government-type loans. That's the Main Street lending, the Paycheck Protection, and the EIDL loan. There are some employee retention credits that you are available, for if you did not take the PPP, as well as reimbursements for COVID sick time. We'll talk a little bit about that. Some income tax opportunities in some state and local programs, as well as accessing trade finance. So let me go ahead and move forward into the hot topic of the day with the Paycheck Protection Program. And I'll give a 1-minute overview for anyone that hasn't been entrenched in these details. Brian, if you want to go ahead and flip the slide for me. Great. Oh, actually, we're going to go Main Street lending and then Paycheck Protection. I apologize. So I think as many of you guys know that this program is not actually yet operating. There is a lot of noise around it since there is not a legislative framework supporting it. And there seems to be a lot of questions from both the borrowers and the banks. And so there's going to be a lot of movement, we think, in this piece and really just thoughts on who's going to be accessing it. But generally, this is for companies that have more than 500 employees or don't meet the small business definition, to 10,000 employees, less than $2.5 billion in 19 revenues. There's 2 loan facilities, the Main Street Expanded Loan Facility and the Main Street Loan Facility, the new loan facility. Both of those facilities will be up to $600 billion. There is no loan forgiveness, and the maximum size loan is $25 million. Please do note that unlike the PPP, which was based on really payroll costs, this, what they will be able to borrow is based on their existing and committed but undrawn debt, cannot exceed more than 4 times the borrower's 2019 earnings before, their EBITDA. And again, the minimum loan size is that $1 million. Now, these numbers have moved around a little bit, so where they'll end up falling out, I think, will be interesting. If you could flip for me. So to be eligible, it must be a business. It must be created or organized in the United States under the laws of the U.S. with significant operations in and a majority of its employees based in the U.S. Since many of you on this call are members of the EACC, this is a really important component as to whether you would be able to be even comply with it. It's something that I would spend some time with if you are looking for funding early on before you spend a significant amount of time. You must have been in good financial standing. You'll see that there's a lot of discussion around this currently. They do not want these funds to be used to pay for past sins. And so what that means and how it'll come forward in the finalized framework is, again, still being worked through. And the company itself must not be participating in the primary market corporate credit facility to be eligible. More to come on the Main Street lending, but generally what we're hearing from a lot of our clients is they're not seeing a huge demand for it as the program is laid out today. It is really dependent on the company's, instances. Unlike the PPP, which has a broad application across industries, this one is definitely more looking at your entire credit opportunities and seeing if there is some availability which meets your current needs. So on to the PPP program. Again, just very high level. This is for companies that are defined as a small business. And that means that normally they have less than 500 employees. There are some industries where you can have up to 1,500. So a key for the companies on this phone call, if they are owned by a foreign parent, or if they have financing through a private equity fund or somewhere else where there might be investments, you must apply two key rules to determining if you're eligible. So the first one is you do have to count the worldwide employees of the entire group. And if you are above 500 worldwide, you would not be eligible. The second piece is if you do have financing through, I would say, private equity or other pieces, you do have to apply the affiliate rules. And that generally is, a 20% ownership. And I'm way oversimplifying it. But generally, if you have any funds that come through a private equity line or fundraising, you really need to look at whether you would be eligible for this through the affiliate rules. The loan amounts are 2.5 times monthly payroll plus benefits and company state taxes. Wages per employee are capped at $100K. They're processed through banks or non-SBA lenders, and we'll get into why that's important when we talk about forgiveness. Maximum loan amount is $10 million, and the loans are forgivable, but there are some key tests that you need to meet in order to get forgiveness, and Chris will walk us through those components. So again, on applying, I have as recently as this morning helped a company apply. These funds are still available. There has been a lot of noise around whether foreign-owned businesses can apply at all. And now there's some clarity around what that means. And again, that 500 worldwide employees and applying the affiliate rules are really the two key ones that are specific to foreign-owned businesses. If you have not applied, it is not too late, but it may be soon. So do make sure that you look at this. There is now clarity around what it means, and so companies can feel a little bit more secure about understanding that. There is a key piece of applying for the loan that you need to have an economic need due to the uncertainty of COVID-19, and that has been a really gray area for a lot of companies through the certification process as to whether they meet that requirement. And so when Chris goes through the mechanics of the forgiveness, he'll also talk a little bit about that certification process and what companies do need to certify. So we've been slowly waiting. Originally, it was supposed to be out April 26th, but on the evening of May 15th, they did issue their multi-part PPP loan forgiveness application. And so that is what we will be using today to have our discussion. As you'll see through our conversation here, there is still some open conversation and some potential legislation which may adjust this. So it's really important that you stay in tune with your professional advisors and that you're doing a really good documenting it. But I would love to turn it over to Chris and let him get into the forgiveness component for the Paycheck Protection Program. Chris?
Sorry, I will
Brian?
do the cliche. I had you on mute. Brian, if you could move to the next slide. So the whole purpose of this is to maximize your forgiveness if you took out one of these PPP loans. And the way that the law was structured is if you borrowed money, you had to use it for certain purposes and only those purposes. and some of those purposes are subject to forgiveness. The purposes for which you can use the loans are for payroll costs, which is a defined concept. You can use it for mortgage interest on mortgage loans that were in effect on February 15th. You can't use it for prepayments. You can't use it to accelerate any payments. You can use it for rent and lease obligations on real or personal property. You can use it to pay utilities, and you can use it to pay interest on other debt that was incurred prior to February 15th. The only one of those components that's not eligible for forgiveness is interest on debt that was incurred prior to February 15th. So the other four categories of expenses are subject to forgiveness. However, there is an aggregate cap on the amount that can be forgiven for non-payroll costs, and that's 25%. So at least 75% of the amount you're going to seek to be forgiven, or that you will be eligible for forgiveness, has to be for the so-called payroll costs. There is talk about eliminating that requirement. Frankly, SBA made it up. It was not in the original CARES Act. The CARES Act did not provide that limitation, and that's something that's subject to potential modification by Congress to override what SBA did. There are other components of forgiveness that are going to be based upon facts under the current law that may or may not be in effect on June 30th of this year. So what we're telling people is, because of these potential legislative modifications and because facts may change as of June 30th, there's really no rush to apply for forgiveness. We suggest that people wait unless you know that under the current state of the law, you're going to get 100% forgiveness because, even applying under the current standards. So let's talk a little bit about how you would maximize the forgiveness. So you have to spend the money during a so-called covered period. The statute provides that covered period is the 8-week period beginning on the day that you got your loan. However, for payroll purposes, SBA came out with a modification to that, both in their application and in their guidance that they published, which for payroll purposes would allow someone to begin that 8-week period on either the day they got their loan or the first day of the first pay period following the day you got your loan, if you have a payroll period that is either biweekly or more frequently. So what that means is, if, say, you have a biweekly, every 2-week payroll period, you are permitted to start your payroll payments for purposes of getting forgiveness on the first day of your your first payroll period that starts after the day you got your loan. You're also permitted to get forgiveness for amounts that you pay during the period and for payments that you incur during the period and perhaps make after the period, so long as you make those payments within the first payroll, on the first payroll date after the period. This effectively could extend the amount spent for payroll to possibly 10 weeks of payroll, giving you a hypothetical. If your first payroll period date starts on, some day after you get your loan, and that also is the day on which you make payroll payments for the prior payroll period, you can make the payroll payment on that day and then begin incurring payroll after that day. So you're effectively able to pay payroll during the covered period for payroll that you incurred prior to the covered period. And on the back end, you don't have to have a special payroll period. You can have your normal payroll period go through the end of the covered period. You're only permitted to get credit for that which was incurred during the payroll period, but you're allowed to pay it afterwards in your normal cycles. So that's some welcome relief for people who have biweekly or more frequent payroll periods. The guidance, and a lot of this is going to be driven by an application that SBA put out. It is a daunting document in some ways. I got it right here. It is 11 pages long, and it consists of various sets of instructions, a schedule, and a worksheet. So when going through this, we recommend that, you take a look at it big picture-wise. Don't try to start filling it out right away. And I suspect there are accounting firms that are going to be putting together programs to help people plug in numbers, because you're going to have to keep very, very detailed data on an employee-by-employee basis in order to prove out the payroll amount that you paid, implement the reductions to forgiveness that are mandated if you have reduced full-time equivalent employment headcounts relative to a reference period, or if you reduced salary or hourly wages during the covered period relative to the first quarter of this year. So once you get the big picture, I think the thing that one should do is go to that worksheet, which is at the back of the document, and work your way from the back to the front, because the worksheet is what's going to be driving a lot of these things. Rent, utility payments, mortgage payments, those are easy. You have to have made those payments during the covered period, or if there's a payment date after the end of the covered period, you get to prorate the amount that relates to the covered period and pay it afterwards and still get credit for it. And the reason that you have to do that is because there are three key calculations that need to be made. The first one is that you have to maintain your head count, full-time equivalents per week. The CARES Act provided it on a monthly basis, but the forgiveness application and the guidance provides for an average number of full-time equivalents per week. So that's the number you're going to have to track. And you have to compare your average full-time equivalents per week during your covered period. So meaning either the 8-week period starting on your loan date, or the period during which you are using as the alternative payroll period relative to a reference period that you get to choose. You get to choose either the reference period that started on February 15th of 2019 and ended on June 30th, 2019, or if better for you, you can pick the January 1st, 2020 period through the February 29th period. So you have some optionality there. And as you'll see, there's a few ways that the employer, the borrower, has optionality and may want to consider running alternative calculations to see the way in which they can maximize their forgiveness. So the amount forgivable is subject to a proportionate reduction if your average FTE count during your covered period is less than the reference period. So if you drop your FTE count by, say, 70% during the covered period, the amount that you get forgiven after you run the calculations will be further reduced by 70%. So that's something to keep in mind. There's also a reduction in forgiveness on a dollar-for-dollar basis by the amount by which the average annual salary or hourly wages for each new person that was first hired in 2020 is reduced during the covered period, or if you could go back one,
sure,
please, Brian, or if the existing employees who are not paid at an annualized rate of more than $100,000 during any pay period in 2019, if that is reduced by more than 25% during the payroll covered period, by more than 25% as compared to the first quarter of this year. Thus, if you have salary or hourly wage reductions of less than 25%, there's no impact on your forgiveness. If it's by more than 25%, then you're going to have to do some calculations. So if we can go to the next slide. Let's talk about the requirement to maintain employees. So the first condition is that you have to maintain the same number of full-time equivalents during your 8-week period as you had before the COVID-19 period. As I said before, the reference period is either February 15th to June 30th of 2019 or January 1st to February 29th of this year, in your discretion. There are some special measurement periods that are available to seasonal employers. I'm not going to get into that right now, but you have alternatives for that as well. There are some key clarifications, though, that the law provided. So if, for example, there's ways to undo the reduction in forgiveness or reductions that occurred between February 15th of this year and April 26th of this year. And you have to completely undo those full-time equivalent reductions by June 30th in order to get an elimination of the effect of those reductions on your forgiveness. So there is an ability to benefit from restoring your full-time equivalents by June 30th. If you eliminated jobs by firing or furloughing people, if you bring them back, you can bring back the same person, you can bring back different people, but it's based upon a full-time equivalent calculation. There's also issues that could arise with why the person was terminated. So if somebody was terminated because they voluntarily quit or you fired them for cause, they're not treated as having been reduced. That does not count toward your reduction in equivalence. So you get to treat those folks as though they had retained employment. If you had furloughed somebody for any reason other than cause, and you've asked them to come back to work and they say no, because there's an issue out there of people doing better on unemployment than they are working, and you make a good faith attempt to offer them their position back at the same wages and for the same hours that they had worked before, and you do that in writing and they say no, you could treat those as having not been reducing your full-time equivalents, but there's a condition. You're going to have to report them to the Unemployment Bureau. And SBA is going to be coming out with guidance on how you have to do that. I also want to mention that this is an all or nothing proposition. So if you laid off people between February 15th and April 26th, and you don't fully restore those layoffs by June 30th to get your FTE equivalents back to the way they were during the reference period, then you don't get an elimination of the reduction of forgiveness. So that's an important point. And all of that works itself through as you go through the worksheets. And so this is very tedious stuff. You have to do this on an employee by employee basis, and you have to make decisions based upon what's best for you relative to reference periods. And one other area, in determining your FTEs, you base that on a 40-hour work week. There was some speculation that it might have been 30 to be consistent with the Affordable Cares Act. SBA decided to go with a 40-hour work week. So the way that you calculate that is you say, well, what were the average number of hours worked per week by that employee, and you divide that number by 40. And if the number is 1 or greater, meaning they worked 40 hours a week or more on average, then they're treated as a full-time equivalent of 1. And if the number is less than 1, they are treated as whatever that decimal is, rounded to the nearest tenth. So if somebody worked 30 hours a week on average, they would be considered 0.75. There's a question as to whether or not you round them to 8.8 or you round them down to 0.7. That guidance is still not available yet. However, SBA has given people the opportunity to ease their administrative burden by treating anybody who worked less than 40 hours as a 0.5 full-time equivalent. Now, if you choose that methodology, you have to be consistent across all relevant periods. So if during the covered period, you're going to treat somebody who worked less than 40 hours as a 0.5 FTE, you have to treat that person as being a 0.5 FTE during the reference period that you're making the comparison to. That may be beneficial to you. It's going to depend upon the facts and circumstances, and that's another area where you may want to run alternative calculations on an employee-by-employee basis. We can go to the next slide. The next area where forgiveness can be reduced is based upon whether or not you reduce salaries or hourly wages. So the forgiveness is reduced by the amount that the average annual salary or wages for each new person hired in 2020, even if that person makes more than $100,000 on an annualized basis, is reduced by more than 25% during the covered period as compared to the first quarter of this year. And for each existing employee who was also employed during 2019 but did not receive during any pay period more than $100,000 on an annualized basis, if their wages or salary are reduced by more than 25% during the covered period as compared to the first quarter of this year. As I mentioned before, if the reduction in salary or wages is less than 25%, there's no reduction in forgiveness. You have to do this employee by employee, so you don't get to kind of even it all out across your entire employee base. So you have to track this for each employee, and if there is this reduction, then you're going to have, and then you add them all up, and that's your dollar for dollar reduction. The slide shows how you go about computing the reduction for hourly employees. They assume that you use as a base the number of average hours per week they work during the first quarter. You multiply that amount by the amount by which the hourly wages were reduced by more than 25%, and then you get their average weekly reduction, and you multiply that by 8 for the covered period. SBA tried to address an issue of the overlap between full-time equivalent reductions and wage and salary reductions. It's unclear whether they really did an effective job doing that. They're trying not to double count it, but I think they didn't provide enough guidance for situations where it both occurs and how the company is supposed to measure that circumstance. And so I think there's some hope out there for some renewed guidance. So you also have the ability, if you reduced wages similar to FTEs, if you did it between February 15th of this year and April 26th of this year, if you undo the salary wage reduction as of June 30th, then you don't have a reduction in the forgiveness based upon the salary wage reductions. So that's next slide. And we talked about the approved purposes before. The areas within which you are permitted to have a reduction of forgiveness. 4 of the 5 categories are subject to forgiveness. The only one that's not entitled to forgiveness is interest on debt incurred prior to February 15, 2020. And to the extent that you had an EIDL loan, an economic injury disaster loan that was financed into the PPP loan, the amount of the EIDL advance that you got is also not subject to forgiveness. Next slide. And they also provided for certain clarifications. So when it comes from we talked about the alternative payroll date, payroll period covered date, which allows you to potentially get more payroll periods covered within the 8-week period. They are very clear that the cash compensation that you are allowed to get forgiveness for any employee is not to exceed $15,385, which is 8/52 of $100,000. Recall that I said it's possible that you could squeeze in more payroll periods during the covered period, depending upon how your payrolls fall and the elections you make. However, even if you do that, just note that you're not going to be able to get forgiveness for any individual employee of more than $15,385. Also know that your aggregate forgiveness will be reduced so that no more than 25% of your non-payroll costs are forgiven. Next slide. We think that there's a lot of documentation that you have to maintain within the forgiveness framework. We recommend that there be a separate bank account where those funds are maintained, and that you use those funds solely for the permitted purposes so that you can easily audit and trace them. If you have payroll, for example, that no more, and you have employees that make more than $100,000, only the amount that would be up to the permitted amount should come from this account. Other accounts should be the funds where monies are used to pay the payroll in excess of $100,000. There's lots of different ways to track and do this. Some people, that's not practical, but the key component here is to be able to track, trace, and have an audit trail. Documentation is really important. There are a lot of documents that have to be maintained. They're listed in the back of the application, and they have to be maintained for 6 years, and they have to be able to be made available to SBA or the lender when it comes time for proving out forgiveness. Next slide. And we talked a little bit about legislative changes. The reason why we encourage people to not apply for forgiveness yet is there are facts that could still come into play by June 30th if you're planning for those. And there are some also legislative changes that are possible, which might make these PPP loans more valuable to you than they otherwise might be based upon your current situation and how the law is currently written. Next slide. Oh, go ahead, Amy.
Yep. So thank you so much for that overview. We had a few questions that came in that I'll quickly try to address so we can kind of bring it full circle. So there was a question about the fact that is the loan proceeds taxable? And so, on the slide it said federal, they're not taxable on a federal basis. And so currently the guidance says you cannot take the expenses and you will not be taxed on the loan proceeds. Most of the states have not come out with guidance yet as to whether they'll follow the federal tax piece. So it isn't clear whether it would be taxable at a state basis. We're expecting most states to follow, but if you live in the U.S., you never know for sure, right, Chris?
That's right. That's right. And there's some pushback on the expense limitation because unless there's a perfect Venn diagram between the layoffs that you would have done and those that you retained as a result of getting this loan, the lack of a deduction for the forgiveness actually is resulting in taxation of the amount forgiven, which was not Congress's intent. So that's one of the areas that they are thinking about fixing to make sure that you can still take the expense associated with the loan. Some people say, well, you're double dipping. You're double dipping depending upon a specific fact pattern. And I think Congress intended for these loans not to be taxable at all.
I would agree. So you raised a point, and a few questions have come in on this. So you're exactly right to say accountants are creating some sort of tool to help their clients. I can speak for us as a firm. I highly recommend if you are someone that has multiple employees and there's some complexity to really reach out to whoever your service provider is, because there's a few key points that are happening here. So one, Chris hit on this earlier, and I think it's so important. There's no reason to rush forgiveness. If you are not getting 100% under the current rules, the 6 months, you should wait to see if there's any benefit that you're going to get from any legislation changes. And by using your accountant to help you, if they're tracking the data, they can kind of let you know that. Now, again, it depends on the complexity piece as it goes forward, but I would think about it as having an audit binder to track every dollar that you're going to ask for forgiveness on, that goes with it. There's a question about the dates. So if a loan was funded on May 1st and they do semi-monthly payroll and the first payment's on May 15th, could they start their covered period on May 15th? Chris, I think the answer to that with the new guidance is yes. So it allows you to use that as your start date for your covered period.
And you can also make your first payroll payment for the prior 2-week period in May on May 15th. That's how you have the potential to extend the benefit of this to more than 8 weeks of payroll.
There's another question about the accounting. The loan terms are 6 months and 2 years repayment with 1% interest. Does interest accrue during the 6-month grace period? So per accounting rules, you should be accruing the interest until your forgiveness is officially received. That is the accounting rules surrounding that component. Once your forgiveness is received, you would reverse it if you did receive full forgiveness. So there is that one. Here's an interesting one with the new rules, Chris. How is comp paid to owners of S corps treated?
So if the owner of an S corp is a W-2 employee, I think they're treated as a W-2 employee.
Correct.
If you are an owner of an LLC, you get K-1 income, and you are capped at the lesser of $15,385 or your annualized net owner's comp from 2019 at $100,000, no more than in no event more than $15,385. And if that number is less because you made less in 2019 from an owner's comp perspective, it's capped at that number. Amy, I think there's a question though as to the extent to which retirement payments that come out of their net compensation can be added back to it or not. I think the guidance said it can't be, but I think there's a question.
Yeah, I think it's the timing of the payment. So I think there's 2 points that are really interesting on the paid to owners piece that just came out last week. So one is you are limited to that net income, and you would not be allowed to take wages from any other employees from that LLC calculation. And that is something that is a really hot topic that people are pushing back on because it's not really in line with the intent of the program. So if you're in that boat, I would definitely stay attuned to what's happening to see where it will come out. And then on your point, Chris, on the retirement package and also commissions for any of you that have large commission payments on a quarterly basis. Right now they have said it has to be paid in the subsequent payroll. So if you do have we've got a lot of retail clients that obviously if they've paid their employees and they're not getting paid commissions, they might already be below that 25%. So if you are a company that has variable comp, really take a look at it, do your forecast, and think really about how you're going to pay them the expenses related to the incurred period. Those are really important and could have a material impact based on how the rules are laid out. We're running a little bit late, so what I'm going to do is go ahead, Chris, and see if you want to have any other closing comments, and I'll deal with the rest of the questions online. I'll respond. Anything you want to say in closing, Chris?
No, I was just going to say, this is complex, it's detailed, and it's tedious. Things are evolving, much like the application process evolved. So I think the rush to getting something done, unless you're getting 100%, you shouldn't rush. You should stay in close touch with your professional advisors. We're updating documents that we have links to, which we'll provide to the organization that they can make available to all the members. We call it a PPP roadmap, and we're updating it based upon this guidance and this forgiveness application.
Great. Well, thank you so much, Chris. It was very helpful. I'm sure a lot of the attendees learned some new pieces based on the guidance that came out. Thank you. William, I'd love to hear a little bit more about where we're headed with the other short-term and medium-term funding options for these individuals.
Excellent. Well, I'm happy to speak on that. Brian, can you move to the first slide of our presentation? Thank you. Okay. So trade finance, this is an alternative funding option for businesses that did not benefit from government-led rescue funding programs or are being denied credit by banks that have tightened their lending standards. What we're seeing in the market is that economists and credit insurance providers are forecasting bankruptcies to go through the roof, especially in the U.S. and Europe in the current environment that we're in. And a lot of traditional banks are getting ahead of that curve by pulling back on working capital facilities for all but the very largest and financially strongest of their clients. So small to medium-sized enterprises and companies with any international footprint, especially in the U.S., have always been underbanked. They've not gotten enough support from the banking community in general, and they rarely get sufficient working capital to achieve growth. So in times of downturn like these, we're seeing this phenomenon being exacerbated. And in the marketplace now, companies that have a higher need than ever before for liquidity, conversely, have less access to working capital. Next slide, please, Brian. Oh, no, sorry. Stick to this slide. Thank you. So trade finance is an area of commercial finance that is best suited for clients buying and selling internationally, startups and scale-ups who may not have an international footprint but are in need of quick access to capital to fuel their growth, and financially distressed companies in need of flexible access to working capital to help them grow back to health. This area of finance typically includes services or financial products such as factoring, purchase order funding, credit insurance, inventory finance, and supply chain finance. Next slide, please. So today I'm going to focus on a few of those, the first of which is non-recourse factoring. This is a form of financing used to accelerate cash flow by securing a lending facility against a company's invoices, their receivables. And it involves mitigating the credit risk of the buyers, the parties billed to on those invoices, not paying as well. So the process works this way. The trade finance company will purchase its client's invoices on day one of the transaction. Typically, the trade finance company will advance somewhere from 80 to 90% of the value of the invoice to the client once the invoices are issued and the client has shipped goods to their buyer. The buyer then pays the trade finance company's bank account at invoice maturity, 30, 60, or 90 days later, for example. Then the trade finance company remits the remaining 10 to 20% of the invoice value to the client and takes out the interest on that final payment. Next slide, please. So this is a summary of the benefits of non-recourse factoring. I just covered the way in which it accelerates cash flow, but then there's also the credit protection element to this service. And the way that works is that after the trade finance company purchases an invoice from its client, the trade finance company then assumes 100% of the risk of non-payment on that invoice due to credit default. The trade finance company will also advise the client on an ongoing basis of the credit quality of their customers globally and can raise red flags when a customer is downgraded. The third component to the service offered is AR management, collections, and bookkeeping. How this works is that after the trade finance company purchases an invoice from the client, they will act as the client's outsourced AR department to follow up with the customer and collect on the invoice wherever the bill to address may be globally. The finance provider also manages the cash application, ensures the client's books, the trade finance company's books, and the buyer's books are all reconciled on an ongoing basis to ensure against discrepancies. This suite of services is a huge benefit to exporters selling to overseas buyers in countries where they may not have any direct representation or staff. It also saves on costs for them dramatically because they don't need to hire staff or register in international markets to have a credit and collections team protecting them from risk of non-payment from their overseas customers. Next slide, please. The other benefits of this type of financing are that the trade finance company is purchasing the invoices from their client in a true sale. So the asset, the invoice, comes off of the client's balance sheet and onto the trade finance company's balance sheet. And the trade finance company then replaces that asset with cash on the client's balance sheet. So this type of financing is not debt, doesn't add any debt to the client's balance sheet. And in fact, it makes the client's balance sheet stronger if they decide they need to source additional debt leverage from banks or non-bank lenders, if they want to raise additional equity or sell their company off completely, because a healthier cash-rich balance sheet makes them more attractive for acquisition. This type of financing can also be set up quickly, sometimes in a matter of weeks, and it can be scaled at the same pace as the growth of the client's business. While traditional banks and other lenders will set covenants on a facility based on profit or EBITDA, which must be met before credit will be increased, trade financing is primarily dependent on the order volume and the credit quality of the client's customers, so it can be increased to whatever level necessary as quickly as sales grow. I've often seen clients of ours that start out, with a 1 million facility, and then within a year or two, they've grown to a 10 or 20 million facility, because that's what the growth of their business required. Another benefit of this type of financing is that it allows clients to keep a healthy cash flow despite the long payment terms their buyers are demanding. This is particularly relevant in the current economic environment resulting from COVID. We're seeing buyers across many diverse industries demanding extended credit terms from their suppliers. Terms are now jumping from 60 or 90 days up to 90 to 120 or even longer. So if you have a factoring facility in place, as a borrower, you're getting paid on shipment. Basically, as soon as the invoice is generated, you don't have to wait 120 days to get paid. We've also seen many scenarios where our clients win new business over their competitors and see a dramatic surge in sales growth as a result of having the capability to support these longer credit terms buyers are demanding these days. Buyers will always favor a vendor who gives them a longer time period in which to make payment. I've seen clients' top line growth in the 30 to 50% range. It's a dramatic increase once they have a facility like this up and running. Next slide, please. In addition to non-recourse factoring, trade finance companies also offer clients financing against inventory and purchase orders. Depending on the finance company, it might be on a more selective basis. And another type of financing they provide is to partner with large buyers and structure what's called a supply chain finance facility. Supply chain financing is also referred to as an accounts payable or reverse factoring facility. It's even sometimes in some industries called a buy or early pay program. So the way this works is structuring a supply chain finance facility starts when the buyer approaches a trade finance company because they need extended credit terms from their suppliers to keep a healthy cash flow. Of course, we're seeing many buyers looking for this nowadays to weather the current economic downturn caused by COVID. The buyer then introduces the trade finance company to all of their suppliers to structure advanced payments on those suppliers' invoices. The result is that the buyer gets the longer time period they need to pay the suppliers, and the suppliers get the suite of services I mentioned earlier connected to non-recourse factoring and ensuring healthy cash flow, credit protection, and monitoring, AR management, and bookkeeping. Everyone wins. Businesses often grow, like I said, 30 to 50% in scenarios like this. Next slide, please. The trade finance is utilized by large companies, especially by SMEs. Our company, TradeWind, serves hundreds of SME manufacturing and trading clients across a diverse range of industries, everything from apparel and textile, automotive components, precision engineered industrial supply chains, agri-commodity, beef and poultry, seafood, consumer electronics, and many more. As long as there's a B2B revenue structure involved, there's going to be an invoice to secure the facility against, then it's often eligible for consideration for a trade finance facility. Clients can range in size anywhere from less than 5 million annual revenue all the way up to $1 billion. Many clients are privately and closely held family-founded companies where the second, third, or fourth generation has taken over the family business, but also many public companies based all over the world use this type of financing. As I said earlier, some are startups and scale-ups, and they need quick access to capital to fuel their growth surge. And others have gotten into trouble, especially in the current environment we're in now, and they're financially distressed, and they also need quick access to working capital so that they can grow back to health. Trade financing works alongside other facilities. In our case, we work alongside banking partners, other types of lenders, whatever our client may need to get the maximum amount of working capital liquidity to grow their business. That's the beauty and the benefit of this type of financing. It's quite flexible. And even in terms of when we consider a new client, we employ flexible underwriting parameters. The client's underlying financials do not have to be immaculate. Where, like I said earlier, a company like us is primarily looking at the credit quality of the client's customers and the overall order volume. Next slide, please.
William, thank you so much for that overview. I think it's going to become more and more important in the coming months as companies get back to operations, and there are some other considerations with pressure in the market. So thank you. I know that we are at time. What I'm going to do is wrap us up with some things for all of you to think about as you go back through what your approach has been to COVID in the United States. So within the U.S., there are other pieces that came out in the acts, and a lot of folks really began to focus on PPP. And then because of either foreign ownership or other things, they decided not to take the PPP loan, or they've taken it and they haven't really reassessed what else is out there. Brian, go ahead and flip for us. So there's a few things just to keep in mind. If you decided not to take the PPP and you have had a decrease in sales, and you have had, if you have less or more than 100 employees, there's different rules, but there is an employee retention credit. You should read the rules on it and get a little bit more information because it is dollar for dollar. It is running through the end of the year. So even if you have a long sales lead time and the impact is going to be in Q3 or Q4, write down employee retention credit and go back and look at it. And I'm happy to have a conversation personally. The next piece is again, if you did not take the PPP loan, or even if you were just funded, for up to two payrolls backwards, you can receive a payroll tax holiday. So what that means is you do not have to pay payroll taxes between now and the end of the year, and you will be able to pay them, the Social Security portion, 50% due a year, so 12/31/2021 and 12/31/2022. And so very important, if you did not take the PPP, this is another piece to get some cash flow, and you should really think about it. And you can, if this is something you're looking at, ask your payroll provider to go back 2 payroll periods. If you did get the PPP or you're still going to get it, you are allowed to use this up until you are funded. Okay. The next item to think about is if you're in a state. Every state has programs, and honestly, in the HEROES Act that they're talking about what other programs are going to come. So if you are looking in your state, you should go to your state website and see if there is something available. These are just reflective. Every state has one, but there is definitely some small business to SME type opportunities depending on where you are. Check it out. The next slide, please. Other cash planning opportunities. Again, with the CARES Act, I think about it 2 ways. There's some federal tax provisions based on what's going on with COVID that you should be working with your tax provider to see if it is something that's helpful. So 1, know your tax footprint. Federal, state, local, income tax versus sales tax versus franchise tax versus property tax. Every single one of them are having different programs about payment time and also the delay there. So know your tax footprint, look at extend deadlines, look at deferral of payments, waiver of penalty and interest, and then also the payroll tax credits. And then make sure that you're talking to your tax provider and looking at internal coordination and discipline approach to maybe get you some cash flow timing. The other piece is really true cash in your pocket. If you want to flip to the next slide, minimizing taxable income, obtaining funds, reducing future payments, and extensions. So the next slide that's there is going to quickly give you some idea of what the CARES Act regarding NOL carry forward, some interest components. The key here is everyone was really so focused on the loans that a lot of people haven't gone back and said, do these apply? Most of you probably haven't filed if you were a 1231 because of the extension. Make sure you're looking at these. These are real money. They can definitely generate some potential opportunities for you. Go ahead and flip to the next slide. This will be sent out so you can look at it, but what this does is it gives you very specific steps to assess each of those for you. So if you actually want to sit down with your provider or someone else that can help you look at if it even applies for you. As we wrap up now, I know we covered a lot of pieces. The goal today was to help you maximize your forgiveness for your PPP, as well as look at other avenues to either, obtain cash flow items or opportunities. We really hope that you found that helpful. There were a lot of great questions, and we truly appreciate all of your time. We will be sending out the materials, and you can request any information from the EACC, and they'll be able to connect you to the right person. I'm going to go ahead and turn it back to Yvonne, and thank you so much for your time today.
Yeah, thank you, everybody. Thank you to our panelists for sharing their expertise on this important topic. Like Amy just said, we are I'm sure many more questions that you might have once you digested what you just heard. So if you do have additional questions, please reach out to the EACC. We're happy to connect you with the panelists for any follow-up questions. Check out our website for upcoming events. We have a program about the future of trade in the post-COVID-19 world. We have a program about the Wayfair decision, an update from Europe from the European Trade Commissioner, a program about cybersecurity and immigration. So lots of important topics in the pipeline. Check the website and do reach out to us if you have additional questions from our panelists. Thank you for attending this morning.